Are you looking for different ways to potentially save on your monthly payment for your mortgage? In this video, we'll be covering using discount points for permanent buy downs and temporary buy downs, and a few different ways to help you save money when you're buying a new home. Okay, so we're going to be talking about seller concessions. What is a seller concession? It is a credit that the seller can provide to the buyer. And we're going to be talking about the maximum amount sellers can contribute. So when we say seller concession, we mean a credit that the seller can provide the borrower. These maximum amounts will be based off the lower of the purchase price or appraised value. We're going to start with conventional loans. If your down payment is less than 10%, the max the seller can contribute is up to 3%. If your down payment is between 10 and 25%, the seller can contribute up to 6%. If your down payment is more than 25%, congratulations, that's a good chunk of change. You can get a whopping 9% contribution or credit from the seller. On investment properties, no matter what your down payment is, the seller credit contribution is maxed out at 2%. Moving on to FHA loans. Although the seller can contribute up to 6%, the borrower still needs to bring a minimum contribution of 3.5% down payment. Now that contribution, that minimum contribution, can be a gift, down payment assistance, or your own funds. On VA loans, sellers can contribute up to 4%. Also, with the VA loan, that 4% can go towards payments towards a borrower's debts. Moving on from seller concessions, we'll be talking about buy downs and how those can help you save money on your monthly payment. All right, so we're going to talk about the first way borrowers can save money using a buy down. So there are two different types of buy downs, permanent and temporary. We're going to talk about permanent buy downs first. You're probably wondering, how much does it cost to buy down an interest rate? The cost of each discount point depends on the loan amount. By definition, a point, also known as a discount point, is 1% of the loan amount. So we're going to look at an example of a $400,000 loan amount. In this example, paying 1 point reduces interest rate by a quarter or 0.25%. So on a $400,000 loan amount, if the offered interest rate is 4%, my goodness, 4% in today's market would be incredible. You would be paying $4,000, 1% of the loan amount, to lower your interest rate to 3.75%. In summary, 1 point, one discount point, is 1% of the loan amount, and it does not equal 1% lower interest rate. Now, the permanent buy down makes a lot of sense in a low interest rate environment. Right now, we actually believe the temporary buy down is a better option, and we're going to cover that in the next couple slides. Okay, so the first type of temporary buy down that I'm going to be talking about is the 1-0 buy down. And it's a temporary buy down because it lowers your effective interest rate for a certain amount of time. With the 1-0 buy down, in year one, your interest rate is lower by 1%. So let's walk through a quick example of this. We're going to use a 30-year fixed mortgage with a loan amount of $400,000 and a contract interest rate of 7%. So in year one, congratulations, you get a 6% using the 1-0 buy down. And this lowers your monthly payment by $263 a month. And in years 2 to 30, it goes back to that 7%. So you might be wondering, why would I want to do this? Why would I just want to lower my monthly payment for 1 year? In today's high interest rate environment compared to 2 or 3 years ago, we are anticipating rates to go down from 7%. So this effectively helps you get into the home and keep those monthly payments more affordable for you. The average cost of a 1.0 buy down is 0.789% of the loan amount. Typically, we are advising our clients to get seller credits to cover this cost. Cost may depend on loan amount, interest rate, and other variables. I'm going to be talking about two other types of temporary buy downs, the 2-1 and the 3-2-1. Okay, the 2-1 temporary buy down. So the 2-1 buy down is similar to the 1.0 buy down because you, the borrower, are getting a lower interest rate for a temporary period of time. So in the first 2 years, your interest rate will be 2% lower in year 1, some big time savings there, and then 1% lower in year number 2. A good amount of savings there as well. So we're going to use the same $400,000 loan amount example on a 30-year fixed loan. Whoa, okay. So this example has a standard interest rate of 5%. We're living in the past here. That's okay. In this example, the buyer would have an effective interest rate of 3% in the first year. Man, that would be phenomenal. And then in year 2, they would have a 4% interest rate. And then in years 3 to 30, we're back to that 5%. If this was as of this recording, this would be a phenomenal deal. So we're going to look at the savings on this. Year 1, we got a 3% interest rate. Your monthly savings, $460.87, $5,530 in year 1. Year 2, 4%, $237 a month, $2,851 annually. And then years 3 to 30, we're back to that 5% interest rate. Just keep in mind, this is not an offering. These are just examples. The average cost of the 2-1 buy down is 2.331% of the loan amount. The 2-1 buy down is a great option. Similar to the 1.0 buy down, we are partnering with excellent real estate agents who negotiate for seller concessions, those beautiful credits that I talked about at the beginning of this video, to cover the cost of this temporary buy down. Last but not least, I'm going to be talking about the 3-2-1 temporary buy down. Okay, now we're talking about a big time win here. The 3-2-1 temporary buy down. Very similar to the 1.0 and 2-1 buy down. The only difference is the first 3 years, your interest rate will be lower. And so on the 3-2-1, in year 1, your interest rate will be lower by 3%. In year 2, your interest rate will be lower by 2%. Year 3, interest rate lower by 1%. Year 4 to 30, you're back at the regular interest rate. So we're going to go back to this time capsule of an example. Loan amount $400,000, interest rate of 5%. This would be a dream scenario. Hopefully we'll have these types of rates next year again in 2024. And now I'm going to walk through the numbers here. So year 1, you're looking at a 2% interest rate. My goodness. That would be a monthly savings compared to year 4 and beyond of $668.81. Year 2, you'd be at a 3% monthly savings of $460.87. Year 3, 1% lower, 4%, effectively a 4% compared to this 5. You'd be seeing a savings of $237.63. The average cost of the 3-2-1 buy down is 4.585%. If you can remember from that first slide, the seller concession slide, depending on the loan type, we may not be able to have the seller cover the entire 3-2-1 buy down. But if you are able to do it, this would be a massive win for you. So now that we've covered the temporary buy downs, I'm going to just briefly talk about the benefits of the permanent buy down and the temporary buy downs and help you figure out in which scenario does it make more sense to do a permanent buy down or a temporary buy down. Now that you're an expert on seller concessions, permanent buy downs, temporary buy downs, you might be wondering, which strategy do I use? When do I use it? So with the permanent buy down, it will always be available. You will always have the option to buy down or pay discount points to lower your interest rate. This makes a lot of sense if you don't think rates are going to get lower. If this rate makes sense for you over 30 years. So when rates were at 3%, paying a few points to lower your interest rate to something in the twos totally makes sense. It is a one-time cost. So if you, for some reason, decide to refinance again, that one-time cost is gone. You're going to have to pay it again on the refinance if you want to lower the rate again. But the reality is if you're refinancing, the rate is probably low enough that it makes sense. With the temporary buy down, it can significantly lower your monthly payment for a short amount of time. So this is great to get into a home and make those monthly payments affordable. The other part of the temporary buy down is it is usually seller paid. So the cost is covered by someone else. This option makes a ton of sense if you anticipate rates to get lower and the goal is to just get into the home, and within the next year or 2 years, your goal is to refinance because you anticipate interest rates going down. This has been a great strategy in our current market. Another item of note with the temporary buy down is any unused funds get reapplied to your refinance. So let's say the temporary buy down was $10,000 and that gets placed into an escrow account. Every month, your monthly payment gets lowered by $300. The $300 gets taken out of your escrow account. And let's say after 10 payments, you've used up $3,000 of the $10,000. There's $7,000 remaining and you refinance at that time. That $7,000 doesn't just get thrown away. It gets reapplied to your refinance. That's why we love the temporary buy down at the moment. Are you having trouble making a decision about this process? That's totally okay. Let us help you decide. So email us at knowyourmortgages@gmail.com and we'll help you decide what types of homes to look for. If you can get a home under contract with seller credits, coming up with the right game plan for it. In our other video, we actually talk about writing the winning offer and then make a decision if you would rather have less cash out of pocket or a lower monthly payment. Ideally, we do both for you. And then obviously, we will help you partner with the right real estate agent. If you thought this video was valuable, please share.